Millions of Americans are sitting on a retirement time bomb right now, and most of them have absolutely no idea it's ticking. Today, we are pulling back the curtain on pension funds, who's protecting yours, who isn't, and how you can tell the difference before it's too late. Let's set the stage. A pension promise is essentially your employer telling you, work hard for 30 years, and we'll take care of you forever. But here's the twist. That promise is only as good as the math backing it up. And a lot of that math is quietly, catastrophically wrong. The catalyst behind most pension disasters isn't some rogue Wall Street villain. It's a slow, boring, decades-long mismatch between what was promised and what was actually saved. Think of it like a restaurant promising a free meal to every customer who ever walked through the door, while only putting aside enough money to feed half of them. On the macroeconomic side, pension funds are betting heavily on investment returns, often assuming they'll earn 7 or 8% annually, in a world where bond yields spent years near zero. When those return assumptions miss, the gap between what's owed and what's available widens like a fault line, quietly, until something shakes the ground. Remember the early 2000s, when cities and states were handing out generous pension sweeteners because the stock market was booming and funds looked flush? Then the dot-com crash hit. Then 2008 hit. And suddenly, those rosy projections looked less like financial planning and more like wishful fiction. Experts like pension actuary John Chalmers have pointed out that most public pension funds today are using discount rates that are, in his words, optimistic to the point of fantasy, while retirees and workers operate under the assumption that the money is simply there. The psychological toll of discovering your pension is only 60% funded after 30 years of loyalty isn't just financial. It's a shattering of an identity-level promise. History is littered with these moments. Detroit filed for bankruptcy in 2013 with nearly $18 billion in debt, much of it pension-related. Central State's pension fund, covering hundreds of thousands of Teamsters, has been in crisis for years. And Puerto Rico's pension system has been described as essentially a pay-as-you-go scheme masquerading as a funded plan. These aren't anomalies, they are chapters in a very predictable book that keeps getting rewritten with different character names. Pension cycles follow a remarkably consistent pattern. Bull markets breed overconfidence, benefits get sweetened, contributions get skimped, bear markets expose the gap, and someone, usually the retiree, absorbs the loss. What makes each cycle feel different is the human element, the faces, the cities, the unions, but the underlying math is almost always the same broken equation. Now let's kill the biggest misconception right here. The government will bail it out is not a retirement strategy. The Pension Benefit Guaranty Corporation, the federal backstop for private pensions, is itself facing long-term funding challenges, and even its coverage has caps, meaning you could lose a significant portion of your monthly benefit, even with the so-called safety net in place. So what can you actually do right now, practically speaking? First, request your pension fund's annual report, specifically the funded ratio. And if that number is below 80%, you need to start treating it like a yellow light, not a green one. Second, look at the assumed rate of return the fund is using. And if it's above 7% in today's environment, apply healthy skepticism, because that number is doing a lot of heavy lifting. Here's the historical lesson that keeps proving itself true. Diversification of retirement income isn't pessimism, it's math. Workers who supplemented their pensions with 401k contributions, real estate equity, or other income streams weathered pension cuts dramatically better than those who relied on a single source. Discipline here means not waiting for your HR department to tell you there's a problem, because by the time that conversation happens, the options have already narrowed significantly. Size your dependence on any single retirement income source, the way a smart investor sizes a risky position, with eyes open, with a ceiling, and with a backup plan already in motion. At the end of the day, the pension system isn't evil. It's a structure built on optimism that keeps meeting reality. And reality keeps winning. Your job isn't to be cynical, it's to be prepared. Because preparation and cynicism are not the same thing, even though they sometimes wear the same coat. Whether your pension is rock solid or quietly struggling, the answer is always the same. Know your numbers, build your redundancy, and never outsource your financial future entirely to someone else's spreadsheet. Comfort doesn't come from certainty. It comes from knowing that whatever happens, you did the rational work ahead of time. And if you're ready to start building that financial redundancy through real estate investing, home equity, or connecting with the right lenders, we can help you get started. Check out our links in the description below.